Karissa McDonough is joining us. She's Chief Fixed Income Strategist at People's United Advisors, joining us on the phone because there's a little storm in Vermont, so appreciate you braving it for us, Karissa. So today we've got a little bit of a sell-off in treasuries. Probably shouldn't be a shock given yesterday's action. What is going to tell us which way this thing goes from here? Because yesterday's move was really extraordinary.
I think what we're going to have to look at is further progress, potentially, on trade talks. I mean, the range of potential outcomes is wider than, I think, what I've seen, following fixed income for many years. We're talking about a range anywhere from, 1.5 to, who knows, 2.5%. That's a huge range on potential 10-year yields. And really what it comes down to is, to what degree does the Fed end up kind of folding and deciding to underwrite this trade war? That's effectively what's happening. If they put in their language in the last release that trade uncertainties were part of the reason that they felt like they had to cut, then I guess it makes sense that the administration would therefore go for more of that type of uncertainty. But it seems to us that neither Trump nor China really has an incentive near term to strike a deal. So as long as this continues to kind of be prolonged, it will have an impact on business confidence, on investment, and really that starts to kind of lead us down to think a little bit about recession, which is not our base case, but that's kind of where we're starting to go. So I think any progress on trade is really what's going to drive this market.
Karissa, what I'm curious about when I look at the one-year chart now of TLT, I mean, it really is now looking like any other basically speculative asset. It looks like the chart of gold. It looks like the chart of Bitcoin. It looks like the chart of Roku. To me, from an observational standpoint, I don't like to throw the word bubble around easily because there's too much stigma attached to it. And historically, people buy bonds for different reasons than they buy those other speculative assets I mentioned. But is there a certain point where we have to think about maybe what's happening here in the bond market from a different perspective than just long-term investors who want to, hold a certain type of asset? I mean, is there a secondary market that's taken over for people who assume that central banks are just going to be able to keep buying up the bonds? That's the question of the day. I completely agree. There seems to be, the amount of whipsaw that we've been seeing in Treasury pricing. Absolutely. There's, and I think your point about the commodities is a good one. As we have yields on these securities dropping lower and lower, that kind of protective balm of your coupon income is less present, so right.
You do have more volatility in the price, and there continues to be just I wouldn't characterize it as a bubble at this point. There is real demand. There are so many equity investors needing to hedge volatility, and the other side of it also is that there are a lot of international investors facing negative yields across the world, and relative to them, U.S. Treasuries do offer some degree of yield, but I've seen strategists come out now suggesting that who knows, maybe we end up negative yields in the U.S. I think that's a long shot, but the U.S. Treasury market is not immune to global flows, and there is just what we're looking at is a capital market, global capital market, awash in liquidity with no place to find yield, and that's what's going on.
Now, what does that mean? And really well said, by the way, because it's a super difficult thing to try and figure out, right? Nobody really knows. But yesterday, and I should say the day before too, this whole week seemed marked by a different tone that I hadn't really heard before, which was just consensus. It's really hard to find other comparables to, where stock bulls want the Fed to cut rates, stock bears want the Fed to cut rates. It seems everybody across the board is certain of one thing, is that the Fed's going to cut a bunch. We're headed towards negative yields, and the status quo is just going to continue. So what happens if that narrative is even the slightest bit wrong?
Oh, goodness. Well, I think there is something to be said for the Fed asserting its independence. I would hope that they would see the importance of the liquidity that they're providing to the market. I think your point about equity investors is well taken, but I think the bond market recognizes that here we are. I just said, like, we've got all this excess liquidity, and yet there are pockets of the market that are still, the liquidity is not as strong as it could be. As the people who can borrow money don't need to, and then there are, companies who may not have direct access. So the Fed recognizes that, if they make a misstep with policy, which it's been a difficult tightrope for Powell this time around. I think the messaging and the execution has been difficult, but he has a tough job right now. I think it behooves them to cut based on global data, but I think that this administration has put them in a very tough spot. He's forcing the issue, and I would not be super shocked if the Fed wanted to just kind of test the waters and say, we are still an independent body. U.S. data remains okay. We know that global flows are not strong. But, you're right. If we saw a shock in terms of the Fed not pleasing the market, then that would cause additional volatility. But, again, never say never. So.
Karissa, real quick, because then we're going to talk some trading here on some of the bond products. But in the last time Powell didn't live up to the market, we had the bond rally as a result, right? Because the logic being that the chance of recession goes up if the Fed doesn't try to prevent it. But to this point, is it possible that the market might respond to a hawkish Powell by maybe being more convinced about the status of the economy, that maybe they don't have to be so bearish?
That's a good point. That could be one response, but I think what would undercut that on the other side would be the amount of exogenous shocks that, whether it's trade policy or weaker global economies, are having on our economy. I mean, the Fed really, the Fed needs to take global situations into consideration. So the U.S. economy may be fine, but that's not really the problem at this point, and the Fed knows that.
All right, really good stuff, Karissa. Great to have you here. We're going to talk some trading in the bond market now. Karissa McDonough is the Chief Fixed Income Strategist at People's United Advisors. Really great commentary